So, welcome to another Code Untapped Tech podcast. You've got myself, Ez, and
got Jay here.
How's it going, mate?
Good, mate. Good, mate. Busy as always, mate.
Always busy. Busy fundraising, I think. That's what we talked about last time, wasn't it?
Yeah. It's interesting because it's not, because we're in interesting times at the moment, Ez.
Yeah. Okay. There's a lot going on out there right now. And, one of the questions I get asked a lot, and I think something we should talk about today is, what's going on in the markets, what's happening with valuations, what's happening with fundraising, what should I be thinking about doing right now, why is this all happening, and what should my plan be, and should I be worried? I mean, are you worried about the stuff at the moment?
I am, because I mean there's been a lot of economic shocks over the last a couple of years, and in particular, obviously, with the stuff going on in Eastern Europe, and it does have an impact on the ability to raise, definitely, and it's understanding those correlations, and then working out what I should do, in order to sort of to give me the runway that I need, to continue in. And it's interesting because you're so, as a founder, you're almost so wrapped up in your little bubble, I need to execute this, I need to raise, trying to execute on me, but actually, you don't exist in isolation, and especially when it comes to raising, because that's something that is external to you. You can't control it, but you can. So you have to understand what's going on in order to take advantage when you need to take advantage. And I think obviously things are volatile at the moment, so what's your view on the markets at the moment, and how does it impact funding?
Well, firstly, if we have just a quick recap of kind of what's happened to get to where we are right now. If we go back all the way to 2008, 2009, the financial crisis, when I think I was back at Lehman Brothers. In order to fix that problem, the central banks globally injected a colossal amount of cash into the system through quantitative easing measures. Right? Well, they basically printed money to try and fix the problem. No bank's too big to fail, all this and the other. And that created an environment where investors had huge amounts of money to deploy. But at the same time, we had record low interest rates. And because we had low interest rates, there's very small returns coming from the traditional investment vehicles. So investors were looking for more high-risk opportunities to start to invest in. So focus started to shift to the startup markets. And then over the course of that time, we saw some big winners coming out of this space with ever greater valuations, more money to deploy. And then we'd start to see the creation of some mega funds. So your Tiger Globals, your Vision funds, SoftBank, and the rest, right? And these are massive, in some cases, almost state-backed funds.
And some massive startups that were invested at that time.
Huge startups.
Stripe. Almost 100 billion valuation.
So Uber, everything. WeWork was part of that. All of these mass Salesforce,
2010 generation.
Huge companies generated off the back of this. Airbnb, all of these companies. So in essence, what we had, you might have heard the phrase, has been like an 18-year bull run on the startup space. So that's where it's just been a good time to be a startup. It's been a good time to be an investor. Right? You almost couldn't lose in some ways. Some people appear to be very, very smart by simply deploying a lot of money, right? So that created a strong upward pressure, increasing valuations to the point where we're no longer talking about unicorns. We're talking where you've got billion-dollar valuation. We're talking about decacorns, where you have 10 multiples of $10 billion valuations to the point now where you've got companies that are worth literally trillions of dollars, right? So we've got very frothy, very excited, high valuation markets. Stock markets are through the roof for similar reasons as well. Now, what then happened? We then had a series of economic shocks that in some cases were self-inflicted, in other cases have been on a global stage. So whether you agree with it or not, we had the situation with Brexit, which has had a huge ramifications for the UK economy and the European economy, both positive and negative. We've had the pandemic, which has obviously created a lot of hardship for a lot of people, but for startups that were involved in anything to do with remote or delivery, again, we've seen their valuations supercharged. They've exploded, where everyone's shifted to buying things online. You suddenly need last mile delivery. There needs to be remote work capabilities. So companies like Hopin, companies like Gorillas, Getir, Zoom, all of these organizations did incredibly well during the pandemic. Amazon obviously went absolutely gangbusters during that time. So huge upward pressure on valuations. And then a couple of big things happened. One, the pandemic came to an end. Now, if you're listening to the podcast, obviously you can't see my finger quotes. So when we say came to an end, we've shifted into a phase whereby people are no longer locked down at home. They're going back to work, or at least they're trying to go back to work. So that has meant less people are buying online, less people relying on food delivery services, less companies are relying on Zoom, Hopin, or other virtual services to run their events and to run their businesses, which meant there's been a big decline in demand for those companies' services, which naturally creates downward pressure on their revenues and their ability to drive value. Secondly, we then had the situation in Russia, where Russia invaded Ukraine. And what most people forget is this happened at the beginning of the year. So this has been going on for months now. Now that's created forgetting obviously, the trauma and the pain that's happened, the human cost of it. What it's driven has been some serious commodity shocks to the global supply chain, right? And it's in the sense that obviously the most obvious one, oil and gas prices have gone through the roof, as we've now seen situations where the EU is talking about putting an end to buying oil and gas from Russia for various reasons. And then also we've seen the impact on food, right? Because oil, gas is required from, generating fertilizer, to powering the tractors, to powering the vehicles that deliver goods from one place to another. But then the actual cost of food, most people didn't realize that Ukraine was such a net exporter of grain. That's been pretty much blockaded, which has then had a huge knock-on effect on animal feed, on food for human consumption. So cost of food has gone through the roof, okay, all across the board, which has then meant that inflation is now running at double digits, which increases the risk of recession as we go forward. And it's becoming increasingly clear that that's going to happen. What that means is less people are spending money because they have less money to spend. It means businesses, their sales are slowing down off the back of obviously the pandemic as well. So we're seeing a huge impact on stock index prices, on company valuations, company revenue. Now, with that backdrop, what we have is this really horrible situation where the stock markets, so FTSE, NASDAQ, all of these stock markets have had a serious tank in valuation, especially those that are being driven by tech valuations. If we look at the NASDAQ, we look at the Fortune 500 and the rest of it, what we're seeing is a massive drop in startup value, in tech company valuations. This impacts the portfolios of pension funds, of private equity funds, and all sorts of other financial organizations who are then having to rebalance their portfolios, because what they had were what were seen as quite safe assets suddenly drop significantly in value. And where you've got these funds also investing in high risk assets such as startups, they're having to retreat from that space because they need to rebalance their portfolios. So that's meant organizations like Tiger Global have almost pulled back entirely from late stage investments. Vision Fund, SoftBank have had to retreat quite aggressively. And you're seeing the same pattern being repeated with other big funds as well. So at the top, you're seeing these large companies, large growth startups, suddenly seeing their access to capital being cut off. Why? Because The other reason is that the cost of raising money from investors has gone up significantly. So the cost of investing in these startups versus just taking out, buying government bonds, for example, that ratio has changed because in essence, the risk-free money has become more valuable. Right? It's become cheaper for funds to buy risk-free assets than to go after the risky ones. So there's a whole bunch of reasons why the big funds are no longer going after the big startups. And where you have companies like Klarna and the rest who have historically relied on growth models where they're running at a loss in terms of revenue versus costs. You know, some of these companies are losing like £60 million a month. They can't afford to do that. Yet they've gone to raise money and they've suddenly found these big mega funds are no longer interested in leading their big, you know, multi-billion dollar rounds. And what you've seen is some big, if they can raise, seen some big cuts in valuation. Right? I think it's like 33% cut in valuation for Klarna. And off the back of that, nearly every single one of these large high growth companies is suddenly having to cut back on staff. Gorillas, Getir,
layoffs.
Klarna, all of them are all cutting back on staff. In many cases, staff that they've only just brought on. Now, that then has a knock-on effect on the lower ends of the market. It all trickles down. So what you're seeing is earlier stage startups struggling to raise as well because they're finding investors are pulling back. They're either pulling term sheets or they're changing the agreements or they're adding in more aggressive terms such as liquidation preferences and the rest. So you're seeing less founder-friendly terms. You're seeing far more investor-friendly. So that's a pretty negative space and negative outlook. But you know, the reality is there is still actually a lot of money out there. And so you've got a lot of funds with cash that need to deploy because every fund has a time horizon across which it has to deploy. But what you're going to see is a lot more, I believe, discipline around the actual investment rounds. We saw last year valuations, so the revenue multiple of like 100x. So you're being valued at 100 times the amount of revenue you're generating at Series A. So by the time you're Series A, you expect to be revenue generating. And we're seeing 100x multiples in terms of the valuation, which is very, very high for context. We're seeing a massive pullback from that now and a lack of appetite from investors to do this. We're seeing organizations like Y Combinator getting a lot of negative press for how they've driven up valuations in the past as well. So ultimately, the market landscape is pretty depressed at the moment. As I said, there's still money out there. You can still raise. You can still get investors to invest in you. But what you're seeing is investors wanting to see slightly different things now. What they want is a focus on profitability and revenue generation, which arguably you could say should have always been the case.
Yeah, I mean, it's the Alan Sugar school of business.
We actually need to make money. Yes, you need to make money. All right. How are you going to make money? We just thought we were going to get money from you guys and just hire a bunch of people. No, that's not going to work anymore, right? So there's definitely a big focus now on what's your business model? What are your unit economics? Do you understand your landscape? And how are you going to grow this business in a way that actually scales? Right?
And brings value that you can charge for.
Exactly. Exactly.
Yeah.
So that's really the landscape where we are at the moment.
So, that was really comprehensive. But so as a small startup, you know, trying to raise, you know, a pre-seed round or something like that, what would be your sort of key points that you would get them to focus on?
So my key points really are both kind of paradoxical, right? One is if you can raise money, raise money. Raise it now, get as much in the door as you can, because we just don't know how long this period is going to be. We don't know what's going to happen when the tranche of cash that's out there gets deployed. Is it suddenly going to dry up for a period of time? So if you can get the money in, get it in. The paradox is if you don't need it and you don't have the traction, don't waste your time.
Because you won't get it.
Because you're not going to get it, right? So if you can, raise. If you can't, focus on extending runway, focus on traction. This is going to be really, really important. And we're not talking just pure vanity metrics, number of users using my platform. No, actual revenue coming through your platform. Even if it's top line revenue, GMV, whatever it happens to be, let's focus on building up your user base, build up revenue through, so that we can show that there is an actual business model here and there are unit economics here that work and will work at scale, and that we have the ability to get sales, right? And that is going to be super, super, super important over time.
So essentially you're saying that's the due diligence that the VCs are now looking at, even the angels are now looking at, essentially.
Exactly. Yeah. And if you're raising right now and you're in a position where you can raise, try and get at least, I always say 18 months anyway, but focus on getting 18 months runway. That's really, really important, because you just, as I said, you don't know how long this time period is going to last, right? So one thing I will say, everything's cyclical. We go around and round and round and round in circles with this. So it's not like this is going to last forever, but it's really about right now being sensible with your burn rates, planning for the future, and making sure you're really taking control of those costs and thinking about, my next raise might not be for another year or 2 years. If that is the case, are we going to be able to continue to run this business?
So a lot of contingency planning.
Planning. What's your plan A? What's your plan B? What's your plan C? How do we push this out? What services have we got? What staff do we have that we don't need right now? And honestly, you're doing them a favor letting them go now, because they have more time to find alternative roles where they can move to. Because there will still be growth businesses even in this environment. And actually what you're going to see, every disastrous situation where there's massive market upheaval, you see a new batch of excellent startups coming out. We've seen this over and over again. Every time there's been a massive crisis,
an opportunity.
It's an opportunity. And not every, but most of the big startups you see today all sprung from periods of great uncertainty. So this is a great time to try to get started, get you started going, because there's people looking for new solutions to problems, right? Because they're going, our costs are too high. How can we do things differently, right? Or they're going, I can't reach my normal customers. How do I find a different customer base? So there will always be an opportunity for those really smart, nimble startups, but just don't load up on cost. Do what you can for as cheaply as you can, for as long as you can.
It's interesting because as a founder, it really does, that can actually shape and affect your roadmap actually, in terms of what features you can build out. Absolutely. And how you get, what, maybe you focus on your core business.
Exactly. Rather than this experiment, that experiment. Oh, that looks great. That's low hanging fruit. What I like to say, in a cash strapped environment, which most startups are, there's no such thing as low hanging fruit. Everything takes resource, takes time. And we talk about this. Every feature you roll out,
it has to add value.
Has to add value, because every feature you release adds additional complexity to your system, right? Which requires support, which runs the risk of breaking another feature as you roll out more features. So you've got to think about that complexity that you're adding. If I add this feature, does it mean I now actually have to add 2 more people to my platform? And how many clients does that get me versus what does that do to my runway?
Exactly.
Or can I hold off on this feature and focus on customer acquisition and start to build revenue, build a pipeline, rather than just rolling out feature after feature after feature after feature after feature? So these are the things that startups really need to start thinking about now. And to be frank, should have always been thinking about, right? Let's be honest. But now it's really going to sharpen people's minds, I think.
So Ez, I mean, that was a great session, actually. And it was interesting because this was it's like an impromptu one. We didn't plan it, and we just thought, based on what we were seeing in the market, and the funding conditions that are around at the time now, it was something that I think it was important to get out to founders, that what's going on and why and why conditions have changed. Yeah. So I think some good insights there. Yeah, definitely.
And we'll always try to react to certain events when we see them, because to us it's about getting the right information out to our founders and making sure that they've got all the tools they need to be able to do what they need to. But it's not about doom and gloom. This type of information isn't about be afraid, right? It's about be prepared.
Yes.
That's what it's all about.
Yeah.
Okay. How do you best navigate this environment?
Because it's important as well. I mean, as founders, that you want all those things. You want to change the world. You want to execute on your vision, but you want to build not just sustainable businesses, but resilient businesses. Absolutely. Businesses that can actually withstand the shocks that can happen at any time. 100%. Yeah. And, so it's interesting that in a climate like this now, that actually that thinking has to be forefront in everything that you're doing, and all of your planning, in all of your financial planning. So as we talked about in the last episode, your fundraising. Yeah. So now this has to be factored in your fundraising, like you said. Absolutely. Get enough money to make sure that you can last your runway. Yeah. Be sensible about how you're spending the capacity that you've got. Focus on features that are really focused on your core business, on building traction. Yeah. Absolutely. Yeah, exactly. Absolutely that. Yeah. So I think with that, I think that's about it for this week. But as always, look, check out our socials, Code Untapped on LinkedIn and Instagram. If you've got any questions or if you've got any ideas for future talks, please message us directly, and always keep an eye out for our pitch practice days, which are the first Friday of every month. And, it'd be great to see you along with the studio. So that's it from me, Jay. That's it from me. Make sure, keep fighting the good fight, and let's get some great startups out. Absolutely. Carry on building, right? Yep. All right, brilliant. Take it easy, guys. Cheers. Bye.